A significant labor dispute has erupted across the U.S. East and Gulf Coast ports, where approximately 45,000 dockworkers have gone on strike, following the breakdown of wage negotiations between the International Longshoremen's Association and the U.S. Maritime Alliance. These ports handle nearly half of the nation's maritime cargo, and the walkout is already sparking concerns about delays in global supply chains. Industries ranging from consumer goods to manufacturing are bracing for increased costs and disruptions, which could spill over into higher prices for businesses and consumers alike if the strike persists. Simultaneously, the geopolitical situation in the Middle East has escalated dramatically, causing additional turmoil in global markets. Military confrontations between Israel and Iranian-backed Hezbollah forces in southern Lebanon, compounded by reports of potential missile strikes from Iran, have raised fears of a broader regional conflict. These tensions have sent oil prices surging by over 3%, crossing $70 per barrel, as the market prices in potential disruptions to the global energy supply. On Wall Street, the combined effects of the port strike and Middle East tensions have reverberated through the markets, with major indexes experiencing sharp declines. The Dow Jones, Nasdaq, and S&P 500 all fell significantly, with tech stocks leading the downturn. Conversely, energy stocks were one of the few bright spots, posting gains on the back of rising oil prices. Companies like ExxonMobil (XOM), Chevron, CVX, and ConocoPhillips (COP) are benefiting from the higher prices, making the energy sector an attractive area for investors seeking to hedge against the volatility. Investors have also flocked to safe haven assets, with U.S. Treasury yields dropping as demand for bonds rises. The port strikes could lead to supply chain bottlenecks that push companies toward alternative transportation options, such as rail and air freight, potentially benefiting stocks like Union Pacific, UNP, and FedEx, FDX. However, disruptions could still mean higher costs for businesses across the board, especially for sectors reliant on just-in-time inventory systems. Moreover, rising oil and gold prices reflect a flight to safety amid the uncertainty. As geopolitical risks increase, gold mining companies like Newmont Corporation, NEM, and Barrick Gold, are seeing renewed interest, alongside SPDR Gold Shares, GLD, and other gold ETFs. These assets serve as hedges against inflation and market instability, which are likely to grow in the face of continued geopolitical risks and supply chain challenges. With the U.S. and its allies heightening their defensive posture in response to the Middle East tensions, defense contractors like Lockheed Martin, LMT, Northrop Grumman, NOC, and Raytheon Technologies, RTX, stand to benefit from increased defense spending, especially as military actions escalate. Market sentiment remains mixed as investors assess the likelihood of further supply chain issues and higher energy costs. Inflationary pressures are expected to mount if oil prices remain elevated, which could lead central banks to recalibrate their monetary policies. As these events unfold, the financial landscape will continue to be shaped by the resolution of the dockworker strike, the evolving conflict in the Middle East, and rising commodity prices. Investors will likely remain focused on sectors that can hedge against the uncertainty: energy, commodities, defense, and safe haven assets, while maintaining a cautious outlook on more vulnerable sectors like technology and manufacturing, which may be directly impacted by supply chain disruptions and rising costs.